2 weeks ago, I talked about how US monetary policy worked. And I noted that unlike Australia, where it's the short end of the yield curve that's important, in the US, it's the long end of the yield curve that's important. The way monetary policy is transmitted in the US is through the yield on long-term mortgage-backed securities, mortgages, and US long-term bonds. Even though the Federal Reserve has only put up rates so far by 25 basis points, there have been enormous rises in both mortgage yields and in bond yields. Last year, US 30-year mortgages were less than 3%. Now, even though the Fed has only put up rates by 25 basis points, those mortgage yields have now risen for the 30-year mortgage to over 5%. So rates have gone up by more than 2% in the US on mortgages. And we expect that to have an effect after a year and a half, between 1.5 and 2.5 years, in slowing down US residential construction. So not next year, but the year after that, you'll have very significant slowdowns in the US economy, US construction. Similarly, what we see is in the effect on the equities market is through 10-year bond yields. Now, US 10-year bond yields back in 2020, in the middle of 2020, were trading at 50 basis points, which is the lowest yield since 1789. Now, this year, even though the Federal Reserve has only put up rates by 25 basis points, those yields have now been trading at 280 basis points, more than 4% higher than they were at the lowest level in the last couple of years. So what we see is that what the Fed is doing is dramatically has had the effect of dramatically tightening monetary policy in the US. Now, why that's important is that major sell-off in long-term securities, major sell-off in bond yields, is now having a negative effect upon both the US equities market and the Australian equities market. And so that allows us to update our models of what's been happening in the US equities market and the Australian equities market. Moving first, just talking about right here in Australia, our bond yields have gone up at the same time as US bond yields have gone up. But we've got a pretty good model of the ASX 200, which over the last 20 years of data explains 91.7% of what's happening in the ASX 200. Now, when we looked at this at the end of last year, it told us that fair value back in December 2021 was 7,416 points. Then we had a really, really good earnings season in Australia in February and March. And the result of that was to push up that fair value to 75.93, just under 7,600 points. But what's happened since February is we've had an increase in our bond yields in line with the increase in US bond yields. And what that's done is that knocked down fair value to 74.15 points. And that's pretty much exactly the same as where fair value was in December when it was 7,416 points. Only 1 point different from where it was. So the effect of this bond yield increase, both in the US and Australia, is to knock the outlook for the Australian stock market from a rising outlook to basically a flat outlook, a flat but stable outlook. Now, what that means is our earnings growth in Australia is so good because of the results of our mining companies, is that it has balanced the effect of rising US and Australian bond yields. Now, that's a different situation than in the US. What's happened in the US is they had really, really good earnings last year. But this year, earnings are growing more slowly at a more normal pace. So the result is their earnings growth this year, even though it's still positive, isn't enough to compensate for the negative effect of the increase in bond yields. So what we see when we look at the model for the S&P 500, the model is very powerful. Again, the model explains 92.4% of monthly variation of the S&P 500. But what's happened with fair value is that at the end of last year in November 2021, fair value for the S&P 500 was 4,720 points. And now, with the increase in bond yields, even though US earnings have gone up, that fair value has fallen to 4,100 points. So what that gives you is the outlook for a slowly declining US equities market and a stable Australian market. So right now, the Australian market provides a better and safer outlook than is the case for the S&P 500.